All right, let's dive right into this explainer and discover why relying on raw financial numbers is often, well, just a grand illusion. When you're looking at a company's accounts, it is incredibly tempting to just zero in on that final profit number and assume you know exactly how well they're doing. But today, we're going to see exactly why those absolute numbers can actually be a massive trap. Let's set the scene with two food retailers. First up, Fresh Foods plc is pulling in a massive $300,000 in net profit. Meanwhile, Food Store plc is making a seemingly measly $30,000. So at first glance, Fresh Foods looks exactly 10 times more successful than Food Store. If you're an investor, you might be tempted to bet the whole farm on Fresh Foods, right? But as financial detectives, we really need to look way deeper than just the absolute amount of dollars left over at the end of the day. Because here is the twist that brilliantly illustrates the truth. To really measure success, you have to look at the actual capital invested to make those profits. Fresh Foods actually used $900,000 of capital to get their return, meaning they earned 33.3% on their investment. But what about Food Store? Well, because they only used $60,000 of capital to get their profit, they actually earned a staggering 50% on their investment. So despite the lower raw numbers, Food Store is absolutely the far more efficient and successful business. So here is our game plan for today. We're going to use ratio analysis as our decoder ring to solve these types of financial mysteries. We'll cover the raw profit illusion, measuring true profitability, the critical nature of short-term liquidity, stakeholder perspectives, and wrap it up with a real-world case study. Starting off with Section 1, the raw profit illusion and why absolute numbers deceive us. Let's clear up the single biggest misconception in business analysis. It really all comes down to a fundamental mix-up between two completely different concepts, profit versus profitability. Raw profit is just the absolute amount of dollars left over. It's like pocketing $5,000. But profitability? That's entirely different. Profitability is the percentage that proves how efficiently a company is actually using its resources. It is a relative measure that compares your returns against either your sales revenue or your invested capital. Moving into Section 2. Measuring true profitability with performance ratios. Let's dig into the actual formulas we use to uncover what's really going on behind the scenes. First up, the return on capital employed, or ROCE. This is essentially the ultimate test for management. You take the net profit divided by the capital employed, which, by the way, is the total long-term capital, including shareholder equity and long-term liabilities, and then multiply by 100. This tells us exactly how many cents come back as profit for every single long-term dollar invested. If a company's ROCE is increasing year on year, it means management is running that business with incredible efficiency. Next, we have the gross profit margin. This shows us the percentage of sales revenue a business actually gets to keep after paying for direct variable costs, things like raw materials. So, for example, a 40% margin means that for every dollar of sales, the business keeps 40 cents to pay off its remaining overheads. If a business wants to bump this number up, they can either increase their selling prices, assuming demand is price inelastic, of course, or they can hunt down cheaper suppliers to drive down those direct production costs. Finally, we get to the net profit margin. This is what remains after absolutely all expenses and overheads. We're talking rent, salaries, interest are completely paid off. You just divide the net profit by the sales revenue and multiply by 100. A high net margin is fantastic because it demonstrates exactly how well managers are keeping a tight leash on those fixed overheads. Okay, riddle me this. Here's a bizarre mystery that financial analysts run into all the time. Just take a second and think about this. How in the world can a business actually improve its gross margin, making more money on its direct production, but simultaneously see its net margin completely plummet? Well, let's look at the numbers. Between 2017 and 2018, the gross margin jumped from 20% to 24%. That sounds like excellent news, right? It means direct production costs fell or their prices rose. But check out the net profit margin. It actually dropped from 14% down to 12%. So what's the takeaway here? Even if production costs fall and gross margin rises, a sudden, dramatic increase in fixed overheads, like a huge spike in rent, aggressive marketing spend, or massive interest payments, can just completely wipe out your net margin. That brings us to Section 3, liquidity, or surviving the short term. Because while profitability is absolutely fantastic, we really need to pivot and talk about the actual lifeblood of any business. Here's another amazing paradox to wrap your head around. You might naturally assume that making a solid profit basically guarantees a company's survival. But what happens if that profitable business simply runs out of immediate cash?
If a company makes massive credit sales where they haven't been paid yet, or buys way too many expensive assets, they might look highly profitable on paper but be completely illiquid in reality. And make no mistake, if you can't pay your suppliers or clear your bank overdrafts on time, creditors can absolutely take you to court and force you into bankruptcy.
So, to avoid that exact disaster, we use liquidity ratios as our early warning system. The current ratio measures our ability to pay short-term debts by comparing all current assets to current liabilities. But if we want a much tougher reality check, we use the acid test ratio. Notice how the acid test completely strips out unsold inventory or stock. Why do we do that? Because you absolutely cannot guarantee that a warehouse full of products is going to turn into cash quickly during an emergency. Ideally, you want this tough acid test ratio sitting right around 1.0. Moving on to Section 4, Stakeholders and Data Limits. Let's explore exactly who is digging into these clues and why we have to admit that the numbers themselves are sometimes a bit flawed.
It's fascinating because different stakeholders use these exact same accounts for vastly different reasons. Managers are analyzing these metrics to figure out if they need to shut down an underperforming department. Investors, they just want to predict if the share price is about to take off. Banks are strictly checking for bankruptcy risk before they hand over a loan. Meanwhile, workers and trade unions are hunting for profit growth to find a solid justification to demand higher wages. Every single group comes to the table with a completely unique motive.
But we really can't trust these numbers blindly. They have some serious limitations. For starters, they are strictly based on past data, which means they do not magically predict the future. They're also frequently skewed by rising inflation, which makes comparing year-to-year performance super tricky. On top of that, different companies might use wildly varied accounting methods to value their assets. And perhaps the biggest catch? Published accounts are heavily summarized. They intentionally hide all those juicy departmental secrets that only the internal managers get to see. Let's pull it all together in Section 5 with our final case study, Triton Canning. I want you to step into the role of the lead financial detective here and analyze this real-world scenario. All right, take a look at these numbers. Between 2017 and 2018, Triton's sales revenue jumped by a massive $500 million, going from $2,500 million to $3,000 million. Gross profit went up too, which is great, but then look at the bottom line. The net profit strangely dropped from $140 million down to $120 million. And this happened even though they threw another $100 million of capital into the business. Something is seriously off here.
And when we actually run our ratio formulas, the hidden truth is completely exposed. Despite making $500 million more in sales, Triton's ROCE and net profit margins both declined drastically in 2018. Their ROCE dropped from 15.6% down to 12.0%, and their net margin fell from 5.6% to just 4.0%. They are absolutely selling way more products, but they've become dramatically less efficient at converting those massive sales into actual bottom-line success.
So as we wrap up this explainer, I'll leave you with this burning question to ponder. If a company's sales explode by $500 million, but its overall efficiency absolutely plummets, what hidden overhead expenses is management failing to control? When raw, top-line growth creates an illusion that completely masks falling efficiency, who is really holding the management accountable? Think about that next time you look at a balance sheet. Until next time, keep looking well beyond those absolute numbers.